Alphabet $25 billion bond risk. Warning to investors or massive growth. Alphabet's $25 billion bond risk demands that you strengthen your AI capital strategy and build smarter growth. You're watching a $25 billion bond sale, but the real story is bigger. Alphabet has raised over $114 billion in AI-related debt since 2025, proving AI is increasingly fueled by borrowing, not just booming profits, and that should make you think. Investor demand reached nearly $115 billion, about 4.6 times the offering size, trailing only Oracle's $129 billion and Amazon's $126 billion bond demand. Strong confidence. Yes, but confidence alone never guarantees profitable execution. Technology companies are projected to spend more than $730 billion on AI infrastructure during 2026, creating one of history's largest corporate investment cycles. But massive spending has repeatedly destroyed shareholder value when governance failed. You shouldn't mistake cheap capital for smart capital allocation. History shows that excessive infrastructure investment, from telecom in 2000 to cloud overcapacity in earlier cycles, often punished investors long before markets recovered. Alphabet's recent negative free cash flow raises a difficult question. Can even the strongest balance sheets comfortably support rising debt while capital expenditure reportedly approaches $205 billion and AI commercialization still remains uncertain? Institutional investors increasingly judge companies using free cash flow, debt servicing, return on invested capital, and infrastructure utilization, because revenue growth without financial discipline has repeatedly disappointed markets over multiple economic cycles. AI has clearly entered an infrastructure phase, much like telecommunications, semiconductors, and cloud computing before it. The winners historically were never the biggest spenders, but the companies generating superior long-term returns. L-Impact Solutions believes the $115 billion order book reflects Alphabet's strong AA-rated credit quality, not automatic proof that every AI dollar invested will eventually produce proportional shareholder returns or sustainable profitability. Technology companies had already issued around $194 billion in AI-related bonds before mid-2026, representing roughly 79% year-over-year growth, showing that leverage across the AI industry is accelerating at remarkable speed. If enterprise AI adoption grows even 10% to 15% slower than current expectations, depreciation costs, refinancing pressure, weaker return on invested capital, and lower free cash flow could quickly reshape today's optimistic investment narrative. You should remember, interest rates remain far above the near 0% borrowing era before 2022, meaning every refinancing cycle now demands stronger operating margins, healthier cash generation, and much greater financial discipline than before. Every AI investment exceeding $50 million deserves rigorous sensitivity analysis, measuring internal rate of return, net present value, payback periods, utilization, and break-even scenarios before another dollar of capital gets approved. Maintaining liquidity equal to 12 to 24 months of planned AI capital expenditure, while combining operating cash flow, partnerships, project financing, and selective bonds creates a far more resilient long-term funding strategy. L-Impact Solutions recommends that boards establish AI capital allocation committees, reviewing GPU productivity, infrastructure utilization, customer adoption, operating income, and return on invested capital every quarter before approving additional spending. If projects consistently deliver below 70% to 80% of expected financial performance, you should restructure, delay, or even terminate them early, because disciplined capital allocation consistently outperforms emotional commitment to failing investments. Diversifying investment beyond infrastructure into cybersecurity, workflow automation, enterprise analytics, supply chain optimization, and customer-facing AI reduces concentration risk, while improving the probability of generating multiple profitable revenue streams simultaneously. Treasury teams should stress-test borrowing under 100 to 300 basis point interest rate increases, 15% to 30% slower AI adoption, higher electricity costs, semiconductor shortages, and weaker cloud utilization before expanding leverage. Operational success should be measured through GPU utilization above 75% to 85%, stronger operating margins, lower customer acquisition costs, expanding gross margins, and rising free cash flow, not simply larger data centers. Transparent reporting on infrastructure utilization, debt repayment, capital expenditure, productivity improvements, and commercial adoption strengthens investor confidence, while helping companies preserve investment-grade credit ratings and lower long-term financing costs. The next AI race won't be won by whoever borrows the most. It will reward organizations converting every $1 billion invested into measurable productivity, resilient cash flow, stronger returns, and sustainable enterprise value. Can your AI investments survive a $730 billion debt-fueled reality? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.